Ind AS 113 fair value measurement. So in this Ind AS, we will going to understand how we can determine the fair value which is required by all other standards. Now, what is fair value? Fair value is a price to sell the asset or transfer the liability on an orderly transaction. Orderly transaction means it should not be forced. Transaction should not be forced between the market participants, means independent buyer and independent seller. So while measuring the fair value to sell the asset or transfer the liability, first preference we will going to give to a principal market. Okay, so what is a principal market? Principal market is a market in which transactions are happening on highest volume. So let's understand this with an example. ABC Limited wants to measure the fair value of an equity share, and for that reason ABC Limited has considered NSE and BSE market, and here it is the volume of the transaction in which shares are trading. Okay, so in NSE market there is high volume of transaction than compared to BSE market, and this is the price per share. Okay, so in NSE market it is 100 per share, BSE market is 105 per share price. Okay, so here we will going to consider NSE um, price for fair value, because volume of transaction is more in NSE market. Even though price is more in BSE market, still we will going to take price of NSE market to for a fair value measurement. Okay, if we do not have a principal market, then second preference we will give to a most advantageous market. So we'll take all the market related to that asset and liability, and then we'll compare the net amount. So in case of asset, it should be we'll consider maximum net amount, and in case of a liability we'll consider minimum net amount. Now how we will going to derive net amount? So we will take the price. Okay, and on and that price will going to less transaction cost, transportation cost. Okay, whatever the cost we are incurring, we have to incur for getting that asset sell, that all cost we will going to reduce from the price, and then we'll derive a net amount, and then we'll compare between the markets, and then we will get a conclusion of maximum and minimum net amount. Okay, as the case may be. So by considering net amount, will determine fair value. Let's understand this with an example. XYZ Limited wants to sell a machine. There is no single dominant market, but two markets are available, market A and market B. Okay, so here the selling price is 5 lakh, 4 lakh 90,000, and the selling cost is 10,000, and transportation cost. So net amount is more in market B. Okay, so we'll consider market B's price. We will consider market B's price as in fair value of an asset. Okay, which is 4 lakh 90,000. Um, there is thin difference um, to keep in mind when we are calculating fair value and the net amount. In fair value, we will going to take a price, and we'll going to reduce we'll going to reduce transportation cost. Transportation cost is cost which will incur, that the cost which we incur to take our asset to the market, that will going to reduce. And take so but in net amount we'll going to deduct all the cost which we will incur to sell the asset, but to determine the fair value we can only reduce transportation cost. Okay, so here there is a hierarchy. Okay, so according to this hierarchy we will going to give priority. So first we will give preference to the level 1 input, which is quoted market price of asset or liability. So if we are having quoted market price of asset and liability, we will give first preference to it. But then if we are not having quoted market price, then we will going to take a market price of similar asset or liability within adjustments. Okay, then level 3 input is price based on the assumption and the forecast of the entity. Okay, so now we are not having the market price also of the similar asset or liability. Then we can also derive price based on our assumption and forecast. Okay, so now we will going to understand the valuation techniques in case we are not having the market price of sorry, if in case we are not having quoted market price of asset or liability. Okay, so basically we will understand this approach. ठीक है, तो उसमें first approach is market approach. So here we derive fair value by taking enterprise value of the entity. Okay, so by taking EBITDA and enterprise value multiple, will derive enterprise value. Okay, now enterprise value now includes both assets and also liability, because if today I want to purchase any entity, I have to purchase that entity's asset and also liability. Okay, so enterprise also includes debt, but here we want to calculate equity value. Okay, and equity shareholder को net मिलता है, सब liabilities reduce करने के बाद equity shareholders को मिलता है. But enterprise value also includes market debt, so we reduce market debt from enterprise value. Then cash and cash equivalent are not included in enterprise value, so we will going to add it. We will going to add surplus assets, and then we will going to less adjustments. So adjustments are liquidity discount, lack of marketability, non-controlling stake. So we will going to reduce this all discount, and then we will get an equity value of the company. Then we will going to divide it by number of shares, and then we will get market price per share. Liquidity discount. So this discount means how fast we can convert shares into the cash. Suppose I'm having house A in a Mumbai and house B in a village. Okay, so to sell my house in village, I have to give discount. I cannot sell it in the same price in which I'm selling in Mumbai. Okay, so this kind of discount will come under liquidity discount. Then there is a marketability discount. So this discount is being given on the basis of availability of public market. Suppose there is a listed company's share and private company's share. Okay, to sell private company's share, I have to give discount. In this case also, I cannot sell it on the same price in which I'm selling listed companies share. Okay, otherwise no one will going to buy my shares. Okay, so this kind of discount is known as marketability discount. Then there is a non-controlling interest discount. Non-controlling interest means when we are holding less than 50% stake in the company. So if we are holding less than 50% stake, it means we are not having control in the company. Okay, and because of that we give sometimes discount. Okay, then there is a price earning ratio. So price earning ratio means how much, मतलब what P ratio help us to understand. It is how much market is willing to pay for 1 rupee of profit. This is the formula for P ratio. Okay, so let's take an example of one share whose market price is 200 and earning per share is 10. So PE will be 20. So it means market is willing to pay 20 rupees for 1 rupee of profit. So P ratio shows how expensive cheaper share is compared to the earnings. Okay. To know whether the share is overvalued. Okay, so we use P ratio to know, okay, whether the share is overvalued, fair valued, or undervalued. This is one of the important ratio which which is being used by every investor before investing in any shares. So it is very important to understand practically. Okay, so I have taken an example to make you understand this statement. So let's take an example of shop A and shop B. So shop A's earning is 10,000 per month and shop B is also earning the same. But shop A's selling price is 2 lakh and shop B's selling price is 1 lakh. It means shop A is overvalued. Okay. It means it is having high PE, so we need to be little careful while purchasing shop A. Okay, so how we will going to use this method? So by taking earnings and PE ratio, we can easily calculate market price, and then we'll reduce the adjustments if it is being asked in a question. Then we will get equity value, and then we'll easily get value per share. Then next method is net asset valuation approach. So here we directly take the fair value of net asset of the company. Okay, and then we will divide with the total number of share, and then we'll get a value per share. Then there is an income approach. This income approach is being used in level 3 input, because as we discussed in that hierarchy, level 1, level 2, level 3 wala input, in that level 3 was a method in which we were estimating, and we are using assumptions, okay, to derive at a market price. So this method will going to help us with that, key on the basis of assumption how we can calculate the market price. So value per share is determined by taking present value of projected cash flows using appropriate discount rate. So we will take a present value of future cash flows, okay, and we'll reduce the market value of that. Then we'll add the surplus cash and cash equivalent and fair value of surplus asset. We'll get equity value, and we'll divide with the number of shares. Okay, so combination of more than one valuation technique is also allowed to measure fair value. This both things we will going to understand with the questions. Okay.